we did the episode on final account on partnership. In this session, we are going to discuss and also look at manufacturing accounts, specifically the final account of manufacturing concern business, right? So, then again, if you are first time here watching this video, I'll encourage you to subscribe, follow, like, and share my video to your other colleagues so that everyone will benefit from this. So basically, here we are coming to look at final accounts of partnership manufacturing accounts. So manufacturing accounts is a business or an entity that manufactures or makes their own products. They use their own raw materials and transform them into what? Finished goods or semi-finished goods, right? By the use of factors of productions. Some of these factors of productions are, labor, machines, chemicals, and right, money too. You can use it to manufacture it because they need people, they need materials, chemicals to help them work on these products, right? So that they can transform into what? Final products ready to consume. So when we are preparing our accounts, we need all these costs on the components of costs that you are going to incur. So basically, the idea of manufacturing accounts is to find the cost of production. So to find cost of production, there are a lot of things that goes into the cost of production. So the main reason why we prepare manufacturing accounts is to find the cost of production, the gross total cost of producing the cost. That is the main reason why we prepare the manufacturing account. Then after you have prepared the manufacturing account, you transfer these things to the sales department where you go and find it, because now the item or the product is ready to be sold to make profits, whether make profit or loss. Do you get it? But then when you are transferring the item to the sales department, right, or the income statement, there are certain things that need to be considered. So the transfer could be transfer at cost price. So when we transfer the material at cost price, then there is no portion of what profit margin on the goods that you are transferring. So how we are going to consider it will be different from when we transfer the goods to the sales department at market price. So in it here, when you transfer the goods at market price, there's some portion of profit on it that will lead us to find unrealized profit. But when the goods is transferred at cost price only, there is no portion of profit. So we are not going to find unrealized profit. Unrealized profit is the profit that we have not realized on the closing stock that are still in the receiving department. You get it? So we should take note of that. So basically, as I said, we are going to look at the final accounts of manufacturing accounts, and then you discuss some few basic things that are important, right? So let's stay to end. as I walk you through. So here we go. Here is the final account of a manufacturing concern. So under manufacturing accounts, you are going to look at the manufacturing account itself, right? And that purpose of preparing this manufacturing account is to find the closing stock, the cost of producing that product to the cost of production. So that's the main reason why we prepare manufacturing accounts, to ascertain the cost of production. And when it comes to the trading profit and loss account or the income statement, this is when after we have prepared the product, you will transfer the product to this department. So we have in manufacturing account, we have two departments that you are going to consider. You have the production department, then we have the sales department. The production department is going to manufacture the products, and as a result of manufacturing the product, we need to find or compute the cost that the production department is going to incur to produce the products. Then once the production department is done, then they will transfer the products to the sales department. The sales department is responsible for selling the products to make profit or to make a loss. So here, the point is also to find net profit or a loss. So whether the sales department will also make profit or loss at the end of the day, right? And the balance sheet, as you all know, is to also compute for the capital employed, the closing capital, right? Yeah, so that is the basic idea of this these three accounts that you are going to prepare under manufacturing account, right? Yeah. So then, yeah. So under the manufacturing account, some of the things that will go into the manufacturing accounts is the direct material costs, direct labor costs, direct expenses. So all these three give us what you call the prime cost, right? Then after we will add our products or manufacturing overheads. So under the manufacturing account, I said that we should find the cost of production. How do we find cost of production or production cost, right? Now, to find your cost of production on the products you have produced, we need two things. These two things are, we need our prime cost. Prime cost. So cost of production here is what? Cost of production equals prime cost plus factory overheads. Right. So these two costs will give us what we call the cost of production. But then what then is prime cost? Prime cost is also computed mathematically as direct material cost plus direct labor cost plus direct direct expenses. Right. So these three components will also give you what we call the prime cost. Okay. Then factory overheads are all indirect costs incurred in the production state. Right. So there we have indirect material costs, indirect expenses, and indirect labor costs. So when it sum up all these costs to give us what you call the factory overhead. So overheads basically means so factory overhead, these are the items that is goes into the factory overheads. Indirect material cost plus indirect labor cost plus indirect indirect expenses. So all indirect costs that are incurred. So all indirect expenses incurred in the production department. Here in the production department. Because we have those indirect costs that are incurred under the administration department. So those ones, they will not come in the manufacturing stage. They will go towards the sales department, which is the income statement or profit and loss items, right? So when you are picking the factory overheads or the overheads in particular, be careful of the item that you are picking. Overhead basically means indirect costs, right? Indirect costs. But these indirect costs, we have factory overheads and non-factory overheads. With the non-factory overheads, they go toward the income statement, which is the second account that you are going to prepare. Do you get it? And the factory overheads come into the manufacturing accounts, and the non-factory overheads go straight toward the income statements, right? So overheads, we have two types. which is the factory overheads, and then the non-factory overheads. Right. So these are basically there, and they are all indirect what? Indirect what? They all mean indirect what? Costs. Indirect costs. Right. They are all indirect costs. That's what overhead also means. So guys, so when we add all these things, we are going to get our cost of production. You get? Then we are done with the manufacturing accounts. But then there are certain times you get some adjustment on work in progress. Work in progress. Then we need to adjust for them before we will find our cost of production. And also sometimes when the transfer is at margin, you need to find profit on the manufacturing accounts. That is the cost of production. So when there are transfers at what profit, you need to find profit on that so that we can find the selling price of the item. Also, that will be transferred to what? The sales department. You get it? Yeah. So here, let me read this one. Manufacturing company also prepare final product just like any other final products. Any other company final accounts are prepared from the income statement and statement of financial position. Organizations that manufacture their own products are inside. They don't go in to buy and sell. They are not into buy and selling. So manufacturing account is not a company that goes outside of their company and buy their item before they prepare. They right, they prepare their own they prepare their own product inside. You get it? And they prepare their own items inside the organization. So here we are going to so there is a little changes of how we are going to prepare the final account because they are manufacturing was organization, they sell what they have made. What they have made is what they are going to sell. Together. So that's why we need to prepare this manufacturing account so that we know the cost that will go into the product that you have, manufactured that and we are ready to sell them. You get it? Unlike the soup writer where we started a final account, we just start straight away from the income statement. But here we are not going to start from the income statement because we need to prepare the item before we can send it to the sale department where we start with our income statement account. You get it? So that's the little changes here. So when you are given a question on manufacturing account, the first thing that you need to know is that we need to find your cost of production before, and that is what basically we have. We have work on here. You have find our cost of production right before you start with the income statement. The purpose of preparing the manufacturing account is to find the cost of production in order to prepare the final account. That is the income statement and the balance sheet. Do you get it? So that's basically what I've explained over here. So basically, this is how we are going to find our cost of production. direct material cost, direct labor, direct expenses. When you add these three components, you get the prime cost, and then you add your factory overhead, you also get your cost of production. Now, the main issue here is to find the cost of direct material cost used in preparing the item. So in a manufacturing account, usually the cost of direct material cost will not be given to you in the question. You need to work on it. Here, the cost of direct material cost, it is the same way we use to find the cost of sales under the income statement. So how we find the cost of sales under the income statement, that is the same way you are going to compute for the cost of direct material. So it is the same thing, but then you are going to change certain words. You are going to modify the phrase that you are going to use. So where you see final product, you change it to what? Raw material or what? Direct material. Yes, so when you are starting to find the cost of sales under the income statement, you say that you start with closing stock, right, of final product. But under the direct material cost, when you are starting, you say that closing stock of raw material, right? Then you say you add purchases of raw material, right? So that's how we are going to find for our closing the cost of direct material cost. So basically, this is an example. So to find your raw material cost that you use in manufacturing the product, you say that you start with your closing stock of raw material, then you record it, then you add your purchases of raw material, you add it. Then if there is any adjustment on the purchases, right, you also do it. So if there is any adjustment on purchases of raw material, you have to adjust it. Let's say some of the adjustments are maybe after purchasing it, you return back some of the items that you bought, the raw material that you bought. You need to return it. They were not what you intend to acquire. So if you are adjusting for returns of raw material, returns outwards, you subtract, so you say less returns outwards. And if there's any raw material that you also took, you need to also less it from the purchases. And then one item that you also have to also consider is carriage inwards. So carriage inwards of raw materials, you also add it because it is a cost. It is part of the purchases. It's considered as what a component on the purchase. So we need these three items to adjust on the purchases of raw material. That is returns what outsource of raw material. That's one component, right? Then we also need to adjust withdraw of raw raw material. And then the last one is what? Carriage inwards of raw material. So these three items will be adjusted on the purchases of raw material. So returns out to us, you are sending it back to where we bought it. So you subtract from the purchases of raw material, and withdrawals to something that you are taking it out from the raw material that you have bought. So you also less it. And if there is any carriage inwards in the question, you also subtract, you also add it. You add it to the purchases of raw material. Then after doing this, you get what we call the cost of raw materials available for production. Cost of raw material available for production, right? As in the income statement, you see that cost of raw material available for use. But here you see cost of raw materials available for production. They get available for production. Then you consider the next thing to do is what? To less our what? Closing stock of raw material. Less our closing stock of what? Raw material. Less our closing stock of raw material. Right. Less your closing stock of raw material. You less it from it. Then, yeah. So after you have less it, then you get the next item to use. After you have less the closing stock of raw material, you can now less your raw material withdrawal. So with the raw material withdrawals, you can either adjust it on what? Purchases of raw materials, or you can bring it here to adjust it together with the closing stock of raw material. So either way, you can use it. Whether you adjust the raw material drawings on the pages of raw material, or you hold it there and you come and add it together with the closing stock of raw material, then you less them from the cost of raw materials available for production. Either way, you are correct, you are not wrong, right? So you can use it whether you adjust it on the pages of raw material, or you bring it and add it to closing stock of raw material, then you subtract the two from the cost of raw materials available for production. So either way, you can use it, right? Then when you subtract these two, you get what we call the cost of raw material used. You get it? So this will actually become your cost of raw material what use, and that is what we need to what compute, so that when you now we can add our direct wages. Direct wages is what our direct labor cost. Then we can also add our direct expenses. So here in this particular screen, you don't have any um direct expenses over here, right? So if there's any direct expenses, you also add it to it so that you get the final answer for the direct labor cost. Okay, now we have calculated our direct material cost. We need to also compute for add our direct labor and direct expenses. They are always given. Direct labor and direct expenses are always given in the question, but to get your direct material cost, you need to go through some working. So that's what we have done, right? That's what we have basically done. Your direct labor and direct expenses will be given to you in the question. Sometimes they will give you only direct labor cost. So in that instance, you only add the direct labor cost to or the direct material cost to get your prime cost, right? Also take notes that there are two possible things that may come up to change the figure we are going to transfer. And this is the adjustment on the work in progress. Get it? So the cost of production, if after you have, there is some item that will change the figure that you are going to transfer to the right, and that is if there is any work in progress, then the cost of production will change from gross cost of will change from cost of production to a gross cost of production. So when there is any work in progress, the cost of production will change to gross cost of production, right? So yeah. So basically this is how we are going to what see. So after you have gotten the prime cost, you will say we add factory overheads. And the factory overheads, they are what indirect costs incurred in the factory. So all the indirect costs incurred in the factory, that is indirect material costs incurred in the factory, indirect expenses incurred in the factory, indirect what labor incurred in the factory. You add all of these things to get your total factory wise. Then you add it to your prime cost, you get cost called the cost of production. Now they are saying that if there is any work in progress, you change the cost of production into what? Gross cost of production or cost of goods for produce. The name will change. Cost of production would be changed to what? Gross cost of production or what? Cost of goods produced. Cost of goods produced. And the adjustment for the work in progress is what? Is as follows. So you always add the closing work in progress of raw materials. Add opening work in progress of raw materials, then you subtract your closing stock of closing value of work in progress of the raw materials. Then you add the net amounts, whether it is increase or addition, whether it is a minus or addition, you add it to the cost of production. Then you get what we call the gross cost of production, or what you term as what? Cost of goods produced. This will be the cost of goods, the actual goods that you have produced. You get it? So this will be the item that this will be the figure that you are going to transfer as the cost of the goods that you have produced. If there is no work in progress, then actually, of course, you are going to pick this value 18,000, 186,500, 500, 501, 186,501 into the income statement. That is when, if only there is no adjustment on work in progress, you are going to pick the 186,501 to the income statement. But if there's adjustments on the work in progress of raw materials, then after doing that, this will be the balance. The one I've highlighted will be the figure that you are going to transfer to the income statement as the cost of production. And this cost of production is going to be replaced. It's going to replace certain item in the income statement. Do you get it? It's going to replace certain item in the income statement. So when you get there, I'll explain that. And then we also need to look out for the transfer. We know this cost of production, this cost of goods produced that we are transferring to the income statement. Is it under is the transfer going to be done for cost price or at what market value, right? So if the transfer is going to be done under these things, you need to also know whether you are going to find manufacturing profit or not. So if the transfer is going to be done at market price, then of course you are not going to find any profit, because market price means that, or market price, which is the selling price. If the transfer is going to be done at what market price or market value, we have to find profit on the goods that we are going to transfer to the income statement, and that will give rise to what manufacturing profit. So usually they will give you the profit margin that you are going to use, and this profit margin, the margin is fine. Margin is a percentage on what margin. When you see margin like this spelling, it's a percentage on what percentage on what your selling price. Margin is what percent on percentage on selling price. And markup, when you see markup is also a percentage on cost price. So markup is percentage on cost price, and margin is what percentage on selling price. So if the question gives you a markup of 20, then of course to find your profit percent, we give you that 20% times the, so that one will be a 20% times the production cost, right? 20% times the production cost, right? So that one will be 20% times the what production cost. So 20% times the production what cost of production. You get it? That is when the question gives you what a markup, right? But then there is some instances where the question will give you margin. So when the question gives you 20% of 20% margin, then of course, what you need to do is that you are going to find that 20% on the what on the selling price, not on the cost of production. Because you find the 20% on the selling price rather. And this means that you'll be giving what? The selling price or the market value in the question. The question will provide you with the selling price or the market value. Then you can apply that 20% margin on the selling price to give you your manufacturing profits. To give you your manufacturing profits. So guys, this is the two ways. So first one, if they give you what 20%, 20%, 20%, 20% markup, right? To find your manufacturing profits, we are saying that you apply this 20% on the cost price. Manufacturing profit will be this, equals to that 20% times the cost price. Cost price. Cost price. And this cost price is either the production cost or the cost of goods produced, depending on whether or not you have work in progress. If you have work in progress, then the cost price will be what? Cost of, if you have cost of, we have work in progress adjustment, then the cost price figure that we are going to use is the what? The second cost of, the second figure that we have calculated, that is the cost of goods what produced in our example. Cost of goods what produced. Right? Then you find your manufacturing profit. Then this one will be your manufacturing profit. Now, once you have find our manufacturing profits, right? So this is how you compute for manufacturing profits. When they give you a markup, you apply the markup on the cost of goods produced. But if they give you a margin, then of course, my people, they will give you what? They will give you the selling price figure, markup, margin, where this one is what? Margin. 20% margin is what? Percentage on what? Margin, you see that is a percentage on selling price. So we are going to apply the percentage, the margin on the selling price or the market value to get our manufacturing profit. Now, after doing this, either the markup or the margin, we have computed our manufacturing profit. So now we need to what? Find our, so if they give you market value, then they have given you the selling price. So what you need to do is to find the production cost. So you do change of subject to find your cost of goods produced. But if the question give you a markup, then you have to add to get your market what value. You just add your cost of goods produced plus the manufacturing profits. You add this together to get your what? Manufacturing, the market value. So it is the same way we need to we go through to find the what selling price. So the same thing. So market value equals cost of goods produced plus manufacturing profits. Right. But with the margin, the objective is to what? Find your cost of production. So here, the only thing that you need to do, you need to find your cost of production. Cost of what? Production. Cost of production. So that one will be your market what? Market value. Market what? Value. Minus that one will be your, so you do change of subject, you need to find the, so market value minus what? Manufacturing what? Profit. So these are the two things that you also need to what? Consider. If they give you a margin, you have to find the manufacturing profit on the selling price or the market value. Then from there, you need to compute your cost of production. That is your market value minus your manufacturing profit to give you that. Then you know the figure that you are going to transfer. So after doing that, you represent it on the final accounts of the manufacturing account like this. So you have to transfer the cost of goods produced, manufacturing profits, and then the market value into the what? The next account, which is the income statement. So guys, this will be the end of the manufacturing accounts. So now we are going to what? The income statement. So if there is any manufacturing profit that may give you market value, and the new figure becomes net cost of production. We are done with the manufacturing accounts. We are heading to the income statements aspect of the. Okay. So the income statement, as you already know, this is how we are going to manufacture our income statement. We are going to prepare our income statement. So we always start with your sales or revenue. Here. Then say that less cost of finished goods. Less cost of finished good. You start with your opening stock of finished goods. You get it. Now, you see in the sole proprietor income statement, you see that we should add what? Purchases of raw material. Because here, the manufacturing account or a manufacturing business, they don't do external purchases. You get it? The manufacturing concern do not do what? External purchases, but they buy their own raw materials, then they manufacture it. Now, so here, the market value or the selling price that we have computed will replace the external purchases that we know that we would have brought it here. So the selling price will replace that purchases of what? Add purchases of what? Finished goods. market value will replace that over here. So in a manufacturing account, we don't have external purchase. But of course, sometimes when their stock or their products get finished, their raw material gets finished, sometimes they go out and buy and restock, right? They go and buy external what finished what products so that they will add it to what they have. Maybe they are out of stock. They can all do external purchase. But the idea is that most of them they don't buy external raw materials. They don't buy final products most of the time. But if there is any instance where they give you purchase of raw material and purchase of finished goods, then you have to what add it to this market value. You get it? Then you do your other adjustments, the working, the returns of final what returns out sorts of finished goods, drawings of finished goods, and then carriage inwards of finished goods. So you do the adjustments on that. Then you get what you call the cost of goods available for sale. Cost of goods available for sale. So guys, listen again. Generally, the final, the finished goods, the purchase of raw material is being replaced. It is being replaced by what? Market value that you have calculated here. The market value. This market value, it is the selling price plus the cost of the product that you have produced. And this selling price, since it is embedded with what profit, then we are going to factor in what you call the unrealized profit. The profit that is part of this, at the end of the day, we need to what? Factor in, consider it. So at the end of the day, this market value that you are transferring to the income statement will give us another what? Something which we need to also consider, which is called the unrealized profits. When you get there, I will explain it to you. So you can see here, you have unrealized what? Profits. Because the transfer they are making is at what? Market what value. The profit component or the profit portion of this market value, at the end of the day, we need to what? Realize it. You get? So after going through, you subtract your closing stock of finished goods from, and if there is any finished goods drawings to, you add it, then you subtract it from your cost of goods available for sale. You get what you call the cost of goods sold. Then you subtract the cost of goods sold from the sales figure to get your gross profits. Get your gross profits. Then you consider any other incomes that is coming into the business. So as usual, you bring your manufacturing profits from the manufacturing profit that you calculated from the manufacturing department or the production department. You bring it here, you transfer it. So you see, I bought CD. Those CDs will be transferred to the income statement, which is the manufacturing profit will come in under other incomes, and the market value will replace the purchase of raw material, purchase of what? Final what? Products or finished products. Then the next thing we should also consider is the unrealized profit. So the unrealized profits was as a result of the transfer that we made at what? Market value, which is giving rise to what? Unrealized profits. Now, there are some instances where you need to consider if whether or not you are going to compute market unrealized profits. If the transfer was made at what? A cost price, then you will not factor in any manufacturing profits. And for that matter, you are also not going to consider any unrealized profits. There are situations where we need to consider whether or not unrealized profits will be available or not. Right. So that one, let me show you something. So we have conditions for unrealized profits to occur. So unrealized profits or expected profits or unrealized profits, they are on goods that have not been sold outside the receiving department. So the goods that we have transferred to the sale department, those components that have not been sold is what we are going to realize the profit on it. Because the goods that you are transferring, the market value, the goods that you are, the market value that you are transferring, it is selling price on the goods that you are transferring, the final product that you are transferring to or the sale department for them to sell. So the final product, each of them has a portion of profits. So any one of them that you sell, you are going to get some profit on it. You get it? Now, the idea is that when you sell this, you are going to get some profit on them. So for unrealized profit to occur, or for us to consider whether or not you have to get unrealized profit, there is something that we need to consider. Three conditions must be met for us to compute for our unrealized profits. And one is that there must be transfer from one department. So you know that the other one has been okay because we are going to transfer the market value towards. The question will tell you that you need to transfer the component at what? That will, give rise to what? The first, points. There must be transfer from one department to another. And the transfer must be at what? Cost price plus profits, or what? Market value or selling price. And as in our example, we said that the transfer is at market value. So that one is also successfully what? Done. And it occurs when they have not been sold. It occurs when goods have not been sold. There must be unsold finished goods. And the final point is the most important aspect. Do you get it? So if the two points are met, then of course that means that there are some final products that have not been sold. So that final product that have not been sold, we need to what? Realize. So this will give rise to what? The finished goods, the closing stock of the finished goods in the market, in the store. We are going to use it to what? Compute for our unrealized profits. We are going to use it to compute for our unrealized profits. So how then do we calculate unrealized profits? How then do we calculate unrealized profits? So unrealized profits is calculated as this. Our what is calculated as our manufactured profits times the closing stock over the market value. So to find your unrealized profit, it is your manufacturing profits times closing stock of finished goods over selling price or market or value. So if you want to it is not a matter of chew and pour. So usually we use this ratio and proportion. Market values is equivalent to what? Manufacturing profits. And then the closing stock of finished goods is also equivalent. Closing stock, this closing stock, the closing stock that is in the market that have not been sold is also equivalent to the unrealized profits. So we need to what? Consider the closing stock in the market has some profit that we need to realize. So when you do the change of subject and make unrealized profit the subject of this ratio and proportion, you are going to get that formula as what? Manufacturing profit times closing stock of finished products over your market value. That will help us to find our manufacturing unrealized profits. Unrealized profits. Okay. So once you have done, we also add the total incomes to the gross profit. Then you get our gross income. Then the next thing we are going to consider for the income statement is operating expenses. Operating expenses. Operating expenses. Operating expenses. Operating expenses. Okay. So operating expenses, all the indirect expenses, all the indirect expenses incurred in the administration will come here. So this basically is the non-factory overheads. Basically the non-factory overheads, right? The non-factory overheads, all of them will come here. We said that the overheads, we have factory overheads and non-factory overheads. The factory overheads go toward the manufacturing accounts, and the non-factory overhead comes toward the operating expenses, and that is the income statement or the administration. Now, this non-factory overheads, they have different types. We have sales and distribution. You have those that go to the administration block, and you also have those that go towards the other departments. So right, you have to consider all of these ones when you are doing the operating expenses. So if you don't know where to classify them, you can basically write it without giving them any classifications. You can write them as you can see. It is not by force. Right. So when you are done doing all the operating expenses, you subtract it from your income, total income, then you get what you call the net profit. Okay, so there is something that I want to also add to the operating expenses. This will give rise to apportionment and then the allocation. So under the operating expenses, some of the question will tell you that apportion this to this, apportion this to that. Basically for the overheads, especially for the overheads, which is both the factory overheads and the non-factory overheads. So some of the question will tell you that you should apportion some costs to this department and to this department. Do you get it? So that will give us to apportionment and allocation. So basically, you see we have direct expenses and indirect expenses. The direct expenses, you know that all of course will go toward the prime cost aspect, right? So what I mean is that now what is allocate and what is apportionment? Apportionment means what? Share of common indirect what? Expenses. So so sharing of what? Indirect expenses. And this sharing of indirect expenses is the overheads. The overheads. So that will give you rise to factory overheads and non-factory overheads. So the non-factory overhead and factory overheads, they can tell you to apportion some percent toward the manufacturing accounts and the other or the remaining percent toward the operating expenses. And this apportionment means that you are going to share those factory and non-factory, maybe 40%. The factory overhead, the manufacturing, you should take 40% to the production department and 60% to the operating expenses. And the apportionment sharing, because the expenses are not directly incurred and they cannot be traced to a particular cost center, we usually cannot share them, right? We are going to use some common, basis or some suitable basis of apportionment. And that would be maybe pitches. They give us a ratio, a suitable ratio for us to compute for them, right? And maybe we are going to use other um, suitable, basis. So we have purchases, ratio of purchases, ratio of sales, ratio of floor area occupied, and all of that. So when the question, the item that we are going to apportion is what related, example, discounts received, carriage inwards. These are some expenses that are related to us to purchases. And if there is also bad debt carried out was selling and distribution expenses, discounts allowed, they are also related to what? Sales. So we are going to use the ratio of sales for the department to also do the apportionment to share among the two departments. You get this? That is the sales department and the manufacturing department. You get it? Yeah. So they'll give us the ratio and you do that over there. So to better explain what I mean is that if, for instance, you have sales, right? You said I wish you was electricity. So we have electricity to be, let's say, electricity is total value for electricity is maybe 6,000 in the trial balance, right? So they give us the ratio apportionment, maybe manufacturing. And sales income statements. Income statements or right. So they will say 50% or 40% to year and 60% towards the income statement. So to compute the electricity amount to be taken towards, so this electricity is an indirect expense, right? So the non-factory overheads is also, this one is non-factory overheads. Do you get it? Because it is not going to the factory or the production department. So this one is non-factory overheads. Non-factory overheads, and that one will go to the income statement. Do you get it? And this one is factory and of course it will go to the production or department, factory overheads. Yeah. So to compute the electricity, that figure that will be taken to the two departments. This is how we are going to also that one to 40% over the total ratio. So when you add the total ratio to manufacturing, say that 40% of the total ratio taken toward the manufacturing. So 40% over 100. Every percent is over 100. So times 60,000. 6,000. The answer you get one, you get 4,000. So you get 2,400 will be the answer that will be taken toward the manufacturing as your electricity factory overheads for electricity. And the second one is say that 60% over 100 times 6,000. That one will also give you what? 3,400. So this is how we do the computation. So when you add them, you see that we are going to get 6,000. So this 3,600 will go toward the income statement as electricity figure, and 2,400 will also go toward the manufacturing account under factory overheads. So guys, these are some of the things that you also need to do when it comes to the overheads, especially the indirect expenses. Some of the questions will tell you to apportion parts of the indirect expenses towards the manufacturing accounts and some towards the income accounts. So when you get something like this, you should know how to deal with them properly, right? All right. So when you are done, you get your net profit. The last account will be what we call the balance sheet. Of course, balance sheet. So the balance sheet is presented as like this, right? So you always start with your non-current assets, record everything. You consider your your depreciation and all that, whether street lie or some of years the gate or net book value, the what then you add everything, you come to what the return with current assets, you find your closing stock of all the products. You add the closing stock will comprise the raw material closing stock, the work in progress closing stock, and the finished goods closing stock. All of these you are going to add them. But then when you pick the final products, that one we have to do some adjustments on them before we take the final or the net amount to add it to what the work in progress and the raw material, so that we can get the actual closing stock value for the three items. So the things that you do to adjust the closing stock of finished goods is what? One, provision for unrealized profit for the current year. So if we calculate for unrealized profit, the profit components of the closing stock of finished goods for the current year would have to be subtracted from that. That's what we said, because that is unearned profit on the closing stock that is in the store we have not, earned yet. And so for the current year, you need to earn it. You take it from it, right? You have to take it from it. So you take any provision for realized profits for the current year from the closing stock of the finished goods. And if there is any adjustment for bad debt, maybe you see bad debt in the question, and all of these, you also have to transfer, take it from the closing stock of what finished, products, right? Like we saw in our sole proprietor, preparation, right? Okay, so then you consider trade receivables, your debtors, your debtors. So your debtors too, some of the items that you also have to consider is what? Bad debts. The bad debts, if there's any bad debts on your trade receivables or your debtors, you will take your bad debts from it. And if there's provision for any doubtful debts, you also consider that. The cash and maybe bank also consider, add it to the current asset and find the totals. Then you get a total for current assets. Then you consider current liabilities, trade payables, on loan owings, and bank overdrafts. Okay. So the bank, if the bank balance in the trial balance is a debit balance, it will come under the bank figure will come toward the current asset. But if the bank balance, the balance of the bank amount in the trial balance is a credit, balance, then that means there is what? Over there is what? There is what? You have overtaken or you have overdrawn. So if bank balance from the trial balance, so let's say from the trial balance, the bank balance is what? Is having a debit balance. Then it will be taken as what? Current assets. But if the bank balance in the trial balance is having a credit balance, then it is bank overdraft. That is what's current liability, because you are owing the bank. You have overdrawn your bank account. So this is something that you also have to consider for the bank amount or the bank figure. If it is having a debit balance on the trial balance, it is a current asset. If it is having a credit balance, it's as current liabilities. So you should know where to pay them to, right? Then you add them, you find the total for current liabilities, you subtract from your current, you get this amount, this figure. This is what we call the working capital. Now you add the working capital, add your working capital. You add the working capital. you add the working capital to your total current, non-current assets. Then once you are done, you get this figure called the total assets. Then you get your total what? Total assets. Then you come to your finance by. The finance by, you always have your capital accounts. You take the balance over here, right? Take your balance for the current, the capital account, then you add your net profit that you have calculated from the income statement, add it, then you less drawings. So with the drawings, the one in the trial balance will come, and any other drawings will, come from drawings from raw materials and drawings from final products or finished products. So any drawings, if you have you draw goods from your raw materials, you add it, and drawings from final products, you also add it to the one in the trial balance. Then you add a total to this. You subtract the total. So when you add them, the total you subtract from the your total balance from capital account and the net profit. Then you also add your long-term liability. Add it to them, then the total amount will be the same as your total assets. So this will end the discussion on the final accounts of what? A manufacturing business, right? To end the discussion on the manufacturing, business. Okay, so guys, we are done with the manufacturing accounts and all the issues around with the manufacturing business, right? So basically, this is what you need to do for manufacturing accounts. So if you want a clearer presentation of the manufacturing account, this is a structure. So this is a structure of the manufacturing account and the income statement. But you can also take a look at, so with the manufacturing accounts, there are certain things you also need to calculate. That's the first, you need to calculate for your direct material cost. The second thing you need also to do is the factory overheads. The factory overheads too, you calculate for it, right? You calculate for factory overheads. Then the next item is the work in progress. Work in progress. Then that will be the end of the manufacturing account. Then you come to your income statements. That's the finished goods components of the accounts. Then once you are done, you also be done with your income statement. Then you end the discussion on the balance sheet, right? On the balance sheet, you do all these things, then you are done. So guys, this is the end of our discussion on manufacturing accounts. This is the end of the discussion on manufacturing accounts. So you end here, and also look forward to my next episode on error corrections and suspense accounts as my third episode, right? To also help you in your final accounts, your final exams. Okay. Thank you for joining, and have a wonderful, discussion. Make sure you subscribe, follow, share with your learning colleagues to also have a benefit. So guys, goodbye, and see you later in my next video. Bye.